Very good morning to all. I hope you are doing great. I'm also good. Very warm welcome to my YouTube channel. My name is Dr. Reena and I'm so happy to have you here. In today's video, we are going to talk about these topics: financial statement analysis, in which we have four subtopics: ratio analysis, fund flow, and cash flow analysis, and due point analysis. So let's understand these topics thoroughly one by one. Let's start with the financial statement analysis. Basically, financial statement analysis is a crucial tool for evaluating the company's financial health, performance, and sustainability. It helps the stakeholders such as investor, creditor, and management make informed decisions. Among the many techniques used in financial analysis, and these are the techniques that we used in the financial analysis. First we have ratio analysis, second we have fund flow analysis, and third technique we have cash flow analysis, and fourth we have due point analysis. These techniques basically widely employed to gain deep insight into a company's financial position and operational efficiency. Okay, so let's understand this financial analysis technique in case of ratio analysis. So basically, ratio analysis is a quantitative method that evaluates various aspects of a company's financial health by comparing key figures from its financial statement. It helps in understanding the profitability, liquidity, solvency, and efficiency. So it's very important to know about the ratio analysis. This is a basically quantitative method, and this will help the company to know about the profit, loss, liquidity, solvency, and operational efficiency of the company. And these are the types of ratios. First we have profitability ratio, second we have gross profit margin, third we have net profit margin, return on asset, return on equity, liquidity ratio, current ratio, quick ratio, solvency ratio, which we also called leverage ratio, debt to equity ratio, interest coverage ratio, efficiency ratio, inventory turnover ratio. Apart from that, receivable turnover ratio. So let's understand these ratios one by one. Let's start with the first one, profitability ratio. That means it is basically helpful to measure a company's ability to generate earning relative to its revenue, asset, and equity. And in case of gross profit margin, where basically gross profit is divided to revenue and multiplied with 100, then you can able to find out the gross profit margin in a company. When you want to calculate the net profit margin, then first of all you have to do the net profit over revenue into 100. Okay, in that way you can calculate the net profit margin. After that, when you want to calculate the return on asset, so you can divide the net income by total asset into multiplication of 100, and return on equity, in that case net income is divided by shareholder equity and 100. In case of liquidity ratio, indicate a company's ability to meet short term obligations. And current ratio, that means you can calculate the current ratio by dividing the current asset by current liabilities. And in case of quick ratio, you can take the difference of current asset and inventory divided by current liabilities. In case of solvency ratio, it is very helpful to assess a company's ability to meet a long term obligation. And debt to equity ratio, then you have to divide the total debt with the shareholder equity. Interest coverage ratio, in that case EBIT divided by interest expense, so in that case you can calculate the interest coverage ratio. And in case of efficiency ratio, you have to evaluate how efficiently a company uses its asset and manages liabilities. In case of inventory turnover ratio, where cost of goods sold divided by the average inventory. In case of receivable turnover ratio, where net credit sales divided by average accounts receivable. So let's understand the second technique. We have fund flow analysis. So basically, fund flow analysis examines the examines the movement of funds, working capital within a business during a specific period. It helps in identifying the sources and uses of fund and typically represented by the fund flow statement. That means the statement of changes in financial position. So these are the key component of funds flow analysis. Okay, before this we already discussed the ratio analysis. Ratio analysis is a quantitative method to evaluate the various aspects of company's financial health by comparing key figures from its financial statement. But in that case of fund flow analysis, it is this method is basically used to examine the movement of funds within a business during a specific period. So, first key component of fund flow analysis, we have sources of fund and uses of funds. So, what are the sources of fund? Issues of shares or debenture, long-term borrowing, and sales of fixed asset, non-operating income. These comes under the sources of fund. And uses of fund, that means the purchase of fixed asset, repayment of loan, payment of dividend, increase in working capital. Funds flow analysis helps businesses to understand how funds are generated and utilized, enabling better financial planning. Okay, so it's very simple. Like you have to analyze these things, where you get the money and how you use your money for for the growth of your business. Next, we have cash flow analysis. Basically, cash flow analysis focus on actual movement of cash within a company, helping determine its liquidity and financial stability. It is presented through the cash flow statement, which is divided into three sections. First one, we have operating activities, and second we have investing activities, and third we have financing activities. In case of operating activities, which include the cash inflows and outflows from primary business activities, for example revenue collections, supplier payment. And in case of investing activities, where you have to cover cash used for acquiring or selling asset, for example purchasing machinery and selling investment. In case of financing activities, which include the cash transactions related to equity and debt, for example issuing shares, repaying loan, and paying dividends. So what are the importance of cash flow analysis? Basically, it helps to determine a company's liquidity and ability to meet short-term obligation, and it is very useful for accessing the business sustainability in the long run. And it also helps in evaluating the financial flexibility and investment decision. Okay, so it's very important to know about the cash flow analysis. As I already mentioned you that cash flow analysis is basically focus on the actual movement of cash within a company, and it is helping determine its liquidity and financial stability. But in case of fund flow analysis, it is uh, it is basically helpful, or you can say it is very it is helpful for examining the movement of fund within a business during a specific period, and it also helps to identifying the sources and uses of fund within a company. Fourth, we have the dew point analysis. Basically, dew point analysis is a powerful tool used to break down return on equity into its core component, providing deeper insight into a company's profitability, efficiency, and financial leverage. So this is the formula for DuPont analysis. ROE is equal to, that means return on equity, is equal to net profit margin multiplied with asset turnover multiplied with equity multiplier. And when you want to calculate the net profit margin, that means profitability, so in that case net income divided by revenue. In that way you can find out the profitability within a business. Next we have asset turnover efficiency. In that case revenue divided by total asset. And in case of equity multiplier, or we can say financial leverage, so total asset divided by the shareholder equity. So what are the significance of dew point analysis? It helps in understanding what drives a company return on equity. It identifies whether profitability, efficiency, or leverage is contributing to return on equity changes, and it aids in making strategic financial decisions and performance improvement. So, come to the conclusion. Basically, financial statement analysis through ratio analysis, fund flow analysis, cash flow analysis, and dew point analysis. It provides a comprehensive view of a company's financial performance and stability. These techniques helps in stakeholder access profitability, liquidity, solvency, and operational efficiency, and making them essential tool for financial decision making. So these are the multiple choice questions based on the topic financial statement analysis, ratio analysis, fund flow analysis, cash flow analysis, and dew point analysis. So first question we have, which of the following is a profitability ratio? So right answer is gross profit margin. In case of profitability ratio, we have to find out the gross profit margin. Next question we have, the purpose of funds flow analysis is to evaluate the movement of cash in and out of a business, the profitability of a business, changes in financial position over a period, liquidity of a company. And the right answer is changes in the financial position over a period. It called a it is the purpose of fund flow analysis. In case of fund flow analysis, that means you have to calculate what is the source of the fund and how you use the fund within a company. Next question we have, the formula for calculating the current ratio is, current ratio, that means is calculated current asset divided by current liabilities. Which of the following is not a component of cash flow statement? So right answer is profitability activity, because these are the component of cash flow statement. First one we have operating activities, investing activities, and financing activities, that I already discussed in the previous slide. Here you can see these are the three sections of cash flow analysis. First one we have operating activities, investing activities, third we have financing activities. So next question we have, which of the following ratios would be used to assess the company's ability to pay off its short-term liabilities? So right answer is cash current ratio. Next question we have, in dew point analysis, which of the following is not part of the formula of return on equity? So right answer is return on asset. So these are the part of the return on equity. Next question we have, which of the following best describes the interest coverage ratio? So right answer is A, the ratio that measures how well a company can cover its interest obligations from its operational earning. Next question we have, a high debt to equity ratio indicate a company is less resilient on debt financing. A company has more equity than debt. A company may be higher financial risk, and a company is more liquid. So right answer is C, company may be at higher financial risk. In fund flow analysis, a decrease in current liabilities is treated as the source of fund, uses of fund, and neither a source nor a use of fund and a gain in the cash flow. So right answer is A, source of fund. The formula for calculating return on equity in DuPont analysis is, so right answer is B, net profit margin, asset turnover and equity multiplier. In that way you can calculate the return on equity. Next question we have, what does a negative cash flow from operating activities indicate? So right answer is A. The company is not generating enough cash from its core business operations. Next we have, what does the quick ratio exclude from the current asset? And the right answer is inventory. Next question we have, which of the following is a limitation of ratio analysis? So right answer is B. Ratio are based on historical data and do not predict future performance. Next we have, in a due point analysis, what does a high equity multiplier indicate? And the right answer is B. High financial leverage. Next question we have, which of the following is true about the cash flow from investing activities? And the right answer is A. It includes the inflows, outflows related to companies' long-term investment. Next question we have, the cash flow from operating activities generally include. And the right answer is payment for interest and taxes. Next question we have, if a company return on equity increases, it may indicate the higher financial risk due to the increased debt. Next question we have, which of the following would be considered a source of fund in fund flow analysis? And the right answer is issue of new shares. Next question we have, you have to calculate the asset turnover ratio. Then you can divide the revenue over total asset. Next question we have, which of the following is true regarding a company with a high quick ratio? So right answer is C. It indicates the company can meet short-term obligation without relying on inventory. Next question we have, a company's ability to generate cash from its core operations is best accessed by, and the right answer is B, cash flow from operating activities. Next question we have, if a company has a higher inventory turnover ratio, it indicates, and the right answer is C, the company is managing its inventory efficiently. And the next question we have, in fund flow analysis, an increase in current liabilities is treated as, and the right answer is source of fund. Next question we have, the main objective of due point analysis is to break down the component of return on equity. It is the main objective of due point analysis. Next question we have, which of the following is not a solvency ratio? So right answer is quick ratio is not a solvency ratio. Next question we have, primary purpose of cash flow statement is to measure the company's liquidity and solvency is the main purpose of the cash flow statement. Next question we have, the higher debt to equity ratio indicates that the company has more debt compared to equity. Okay, so next question we have, the equity multiplier in due point analysis indicate the leverage used by the company. Next question we have, in negative cash flow from investing activities typically suggest, and the right answer is the company is purchasing long-term asset. Next question we have, which of the following ratios would help access a company's operational efficiency? So right answer is inventory turnover ratio. So that is all about for the today's video. So we have already left the 3 question more. Okay, so let's discuss these questions. Which of the following is true about a company with a low interest coverage ratio? So last and the right answer is B, the company may have difficulty meeting its interest obligation. And the next question we have, a decrease in accounts payable is treated as, and the right answer is use of funds. Next question we have, if a company has a high ROE, return on equity. That means it generally means, and the right answer is companies using its equity efficiently to generate profit. So that is all about for the today's video. Thank you so much. If you like this video, then do like and subscribe my channel. Have a nice day. Keep learning and keep growing. Keep signing. Bye bye. Take care.